winners per year mathematically. So we looked at theoretical and we looked at historical. And we basically said, it's kind of like, what is a reasonable expectation, assuming a certain set of circumstances, which is like nothing crazy happens. What are reasonable assumptions looking back at history? So at Tasty, we emphasize the importance of consistency in mechanics to help traders have a more reliable results while trading short premium positions. I think I've said this like about 1,000 times. If you want to have somewhat predictable results, you need to create a certain number of occurrences. It's called law of large numbers. Mm-hmm. We're taking that to another level. Even in the perfect theoretical world where every strangle with the same initial delta had the same pop, we would still see a variation in real outcomes because sometimes stocks win. Sometimes, this isn't even assuming that you made a mechanical mistake. This is just assuming that, hey, sometimes the stock wins. So what we're going to do is we're going to compare how the realized dispersion in winners per year stacks up to the theoretical projection as described binomial distribution. Not the easiest study we've ever done, but let's do it. We used 15 years worth of data. We took everything back to 2009. We looked at the options in the SPY, IWM, TLT, that's S&P's, Russell 2000 bonds, Apple, Amazon, and Google. We examined the 45 data expiration strangles. The first one's actually a straddle, 50 deltas. And then we did the 30 and 16. We closed everything at 21 DTE, so nothing was held to expiration. So we're giving ourselves, kind of like the best of all worlds, just to see kind of if that happens, where do the results come in? Does the 16 delta come in around whatever 70% or higher or whatever? Does the 30 delta come in, like at what number? Where are these things going to come in? What about the 50-50? Let's see. So for each year and each underlying, we did 8 strangles because if you multiply 8 times 45 days, it takes you to 360 days.
They're staying mechanical.
Yeah, that's the reason we came up with 8. We're constantly redeploying. Since we're managing at 21 days, there's obviously extra time in there where you could redeploy again, but this is just for the purposes of keeping it really clean. We had some overlapping durations. Those were just selected at random, so they weren't not going to change the results. We looked at how many winners each strategy got for each year, and then we compared that to the binomial distribution with the same success rate and the same sample size. So the sample size in all is going to be 8. We're going to look in this case at realized, and then we're going to look at theoretical. So it's going to be hard because we didn't. So you're going to have to kind of just visualize it. What I'm going to tell you up front is that the visuals are going to look somewhat similar, which should be no surprise, especially managing at 21 days. The realized and theoretical are going to be fairly close.
And before you said they're going to look fairly the same or whatever, wouldn't you, if you were thinking that the market is fair, equitable, and volatility was predictive, you would expect that, wouldn't you?
You would. In case you can't read this, because I can't really read this, the number of years.
If you turn your head a little bit more to the side,
you'll be able to. The number of years with that many winners. You'll be able to read it. And at the bottom, you can see the 8 different segments. This is what it looks like when you talk about the actual 50 delta strangles winners per year. Okay, so this is actual. This is not the theoretical side.
When you were turning your head to the side like that, what were you trying to read? That the numbers of years? Okay, number of years with that many winners.
Today. I'm trying to do everything. Okay, I can't help you that much.
Number of years with that many winners is what it's saying.
Yes, and now that is actual. Now, if you go to theoretical, just kind of picture this in your head, take a snapshot, and this is theoretical. Now, theoretical is going to look more like kind of a normal distribution curve. As you can see, it's not that dramatically different. In real time, you're going to have a little bit more. Some of the winners are going to be a little more exaggerated. It's not going to be as clean. It comes out fairly the same. And those are for straddles. And holding a straddle till 21 DTE is not our favorite approach. And you start getting down to 30 delta strangles. This is the 30 delta strangles winner per year. This looks like a pretty nice distribution curve, right? Mm-hmm. These are actuals. And this is the 30 delta strangle. And this takes you to where kind of like, this is looking back at 15 years worth of data. And I think this one is probably, we don't usually do 30 delta strangles. We usually live in kind of the 20 delta range, which will still be the next slide. But go to the theoretical one, Beth. Go to the next slide, which is theoretical. And it's going to look, you see that almost look the same? This is actual. And the next slide is theoretical. It's almost exactly the same. Now, the reason we wanted to show you this and the reason we wanted to put it out there is because people have to believe in the numbers. Like this is just, this is a very strong quantitative piece to make you want to believe that the numbers play out the way they should play out. One being, so this 16 delta strangles winners per year. And this is actual. Now, this is more of the area that we live in, right? And on the surface for 15 years, pretty good. And again, this is all the, this is the different underlyings and everything else. And the theoretical looks a little bit different on this one. So when you start to get down 20, 15, 16, 20, 22 and a half, maybe 25 deltas, you get a little variation from the theoretical gives you a little bit of variation. The actual gives you a little bit of variation from the theoretical. They're all positive.
I mean, listen, it's what you would expect, right? I mean,
yes. No, it's what you would expect. But I just wanted what
and there's nothing wrong with that.
What Jacob and the team wanted to show to viewers is that if you create enough occurrences, you're going to get to a point where the outcomes are fairly predictable. A large number of independent occurrences is the key to consistent results for retail traders. When trading longer dated options, which we count 45 days as longer dated options, like 0 days would be short, whatever, a week. This requires being willing to trade in a variety of underlyings. For most of the strategies considered, the realized variation in the number of winners per year and the theoretical values were very similar. And that's what I pointed out on all the slides. The exception was kind of the out-of-the-money strangles, which saw more strong years and more weak years, but fewer kind of average years than theoretical. If we can't manage to place thousands of trades, which is fair for a lot of people can't, higher probability trades will converge to theoretical results in fewer occurrences than 50-50 shots. And I think that's really interesting, saying that you take 50-50 shots, outcome's going to be, I think, a lot worse than if you take the approach of the higher probability trades. They just work.